Welcome, everyone. Thank you for tuning in to today's Navigating Taxes update. Today's update is focused on the evolving landscape of PTET, known as pass-through entity tax, elections as a workaround to the federal SALT deductions cap. To guide us through these developments, we're joined by Scott Brawdy, tax principal at Honkamp. Scott leads our state and local tax practice and has more than 25 years of experience advising businesses across industries and navigating complex multi-state tax issues. So Scott, can you explain what pass-through entity tax elections are and why they're becoming an important strategy for certain business owners?
Sure. And I guess let's start with the problem. In 2018, the federal government capped the deduction for state and local taxes, known as SALT, at $10,000 a year, and then raised it to $40,000 as part of the 2025 Big Beautiful Bill. And what's happened is that cap has hit high-income taxpayers and business owners especially hard, limiting their ability to deduct state income and property taxes on their federal returns. So what happened in response to that is 36 states and New York City enacted pass-through entity tax regimes, and these allow pass-through entities to make an election to pay the state income tax at the entity level rather than passing it through to individual owners.
And why does this matter?
Well, because taxes paid at the entity level are fully deductible on the business's federal return. They aren't subject to that SALT cap. So that means more federal tax savings are for you and your partners. And just as an example, let's say you've got a partnership, it earns $500,000 in a state with 6% tax. So without the PTET, each partner would pay $15,000 in state tax and can only deduct $10,000 federally. With the PTET, the partnership pays the full $30,000 directly, deducts it as a business expense, and then each partner gets a state credit for their share of it. And that sounds good, right? But the catch is the PTET elections vary widely by state and are often irrevocable or binding for multiple years. Also, some states like Georgia treat the election as irrevocable once made, while others like New Jersey allow ratification, but only if it's done electronically by the original due date of the return. And speaking of due dates, deadlines also differ. In New York, you must elect by March 15th of the tax year before you even know how much your business will perform. That means you're making a tax decision based on projections and not actuals. And if you overpay, New York doesn't let you apply excess PTET payments to future years or transfer them between entities. Contrast that with California, though, which does allow carry forwards. And another wrinkle is that the residency of the owner matters, because some states offer credits only to resident owners, while others, like Arkansas, exempt non-resident owners from filing if they have no other state income.
Okay, so what should businesses do?
Well, businesses should, first of all, evaluate their ownership structure, especially if they have non-resident or corporate partners. You want to model the tax impact across all states where you operate, and then consult your tax advisor before making a pass-through entity tax election, because these decisions can affect everything from quarterly payments to future mergers or sales. And here's a bonus tip. If you're planning a liquidity event like selling your business, PTET elections can complicate things. A stock sale might trigger unexpected state taxes, while an asset sale could preserve the benefits of the PTET. So the bottom line here is that these elections can be powerful tools, but they're not one size fits all. Take the time to understand your state's rules, weigh the pros and cons, and make informed decisions.
Okay, excellent. Thanks, Scott, for sharing your insights on this important topic. That's it for today's Navigating Taxes update. If you need help navigating PTET elections or modeling your tax exposure, reach out. We're here to help.
I'm Scott Brawdy. Stay strategic, stay compliant.